Bill Gates and Warren Buffett both agreed that Charlie Munger is the most intelligent person they know. Charlie Munger once said, "Problems frequently become easier to solve if you turn them around in reverse. Unless you're more gifted than Einstein, inversion will help you solve problems." Now, let's use a little bit of inversion to solve your trading problems. Around 90% of traders lose money. So what we have to do is ask, what are 90% of these traders doing? First, they buy breakouts and they sell breakdowns. Yes, they're literally chasing the stock price around. Second, they all try to cut their losses short and let their winners run. Where are they letting their winners run to? Straight out of their trading account? This idea sounds great in theory, but it just doesn't work. Third, their greed causes them to size their positions way too big. Have you ever heard the saying, don't overtrade, focus on the best setups, and increase your size on the good ones? Look, there's some merit to increasing your size during periods of better opportunity, but don't overdo it or eventually you'll be wiped out of the game. Number 4, they are afraid of reducing their cost basis because they might be capping their potential profits. For example, selling a covered call reduces your cost basis but caps your potential gains. Now listen, unlimited profit potential is like a mythical creature. Now you see these 4 things most traders do, but why do they do them? Well, some of it's human psychology, but most of it is because it's what they were taught by investment education websites. I know it sounds a bit hypocritical because I run an investment education website myself, but the difference is they tell you what will make you spend money. Unlike them, I will tell you the truth, even if it's not what you want to hear. Think about it. How appealing does cut your losses small and let your winners run sound? Sure, it sounds great, exactly what you want to hear, but anyone teaching this concept has either never traded before or they're just flat out lying. Now, that doesn't mean you have to have huge losses and tiny profits. If you're trading the right strategies, this shouldn't even be an issue. Now let's use a little bit of inversion and flip these points around, and here's your new trading strategy. First, you're going to buy into weakness and sell into strength. Why? Because it's exactly the opposite of what most traders do. Now you might be saying, but if you're getting long into a sell-off, how do you know when the sell-off is over? The answer is simple. You don't. Nobody does. It doesn't matter if you're Warren Buffett or if you're Jimmy Buffett. You don't know if the stock is going to go up, down, sideways, or in circles. And I believe that stock price swings are random for the most part, but ultimately it's human emotion that drives market moves. So just don't fall victim to your emotions. Number 2, you're going to book your profits and be patient with your losing trades. With a high probability trading strategy, almost all losing trades will become a winning trade at some point if you hang in there. If you're cutting your losses small, you're going to choke out a lot of good trades. And if you're trying to let your winners run, you're going to be very disappointed when your winners just don't freaking run like they're supposed to. Number 3, you're going to keep your position sizes small. It will allow you to make decisions based on logic rather than emotion. The only way to be patient with positions is if you're sizing your positions correctly. If they are too big, then the day-to-day fluctuations in your account balance will cause you to make bad decisions and acquire gray hair at a very young age. And lastly, you're going to reduce your cost basis by placing trades with a defined profit strategy. These are strategies with limited profit potential, but they have a very high probability of success. And listen, if you're buying options, you're doing the exact opposite of reducing your cost basis. Consistently reducing your cost basis will pay you far more than that one home run that you might hit. If you swing for the fence, you're probably going to strike out. Raking in small profits over and over again is where you'll hit a grand slam. Following these simple guidelines will save you many headaches and a ton of money.
The reason most short traders lose money is because they do not manage their risk properly. I'll say that again. The reason most traders lose money is because they do not manage their risk properly. They'll have a £2,000 account and they'll place a bet that risks half that account on one bet. And the bet goes against them, they're 50% of their account's wiped out. That's the reason. Risk management, money management, that is the main reason. And then on top of that, it is not having a strategy. But then as soon as you have a strategy, part of that strategy is the amount of capital you risk on every speculation.
Do you have an amount that you risk?
1 or 2%.
Unless it's gold, which case.
Oh yeah, but you see, I made my bets on gold when I was much more green, so I risked far too much.
Do you scale into positions?
I have done.
What about stop and loss trading orders and stuff?
Well, I scaled into gold a lot. Yeah, I do. Yeah.
Would you advise it to people getting into the trade?
Not early on. Once you know what you're doing. I'd recommend, if you're really interested in trading, you're really serious about doing it, I'd recommend trading a dummy account. I'd go and do a course, learn a system, trade that system in a dummy account for 3 to 6 months, and then put, I don't know, £2,000, and then trade that £2,000, that system with just a small amount of money. I'm not saying for 6 months. And only after a year, when your system is so habit, it's like checking your emails or something, you check your thing, only then scale up to significant amounts. I really would take that amount of time to do it. Learn a system, practice that system in a dummy account for 3 to 6 months, and then stick 1 or 2 grand in an account, and then practice that system with a 1 or 2 grand. And that's before you start putting in, remortgaging the house and that kind of thing. I've done it. I've sold a house and bet money on markets. And fortunately, it went well for me, but for a bit, and then it kind of went against me. But I would not advise doing that until you have a definite system in place, and you know the system works, and you know how to do that system, and you can take your emotion out of it, because your emotions, whether it's the emotion of trading or the emotion of you've been to meet the guy with the shiny white teeth who's in charge of the company, and he's all charming and he's told you that we're going to do this, that and the other, and you've believed him, and even though the stock's doing that, the man with the white teeth said it was going to do that, so you stay in. That's not proper investing. It's the thing's going down and you're losing money. You've got to get out. You've got to know every investment you make. You should know at exactly what point you are going to get out if the investment goes against you. That should be your first thing. You have to write a little list of investments, and the first thing is, at what point do I exit? And you need to have that very clear in your mind, because with many of the investments you make, you will reach that point. And that's more important than at what point do I take a profit, or at what point do I, imagining all the money that you're going to make. It's more important to know what your risk is.
Okay.
And the market moves on it only because of retail traders. Professional traders don't trade on it and initiate positions. They use the liquidity to get out. So it's all short-term binary for retail traders. And the short-term binary approach provides liquidity for the smart guys who are predicting the future. It's providing liquidity for them to get out. What's the outcome of a professional trader? What do they want to achieve? Well, the first thing is capital preservation, and then growth. The retail trader wants to achieve big money very quickly, and not necessarily consistency, and the outcome is they just blow up. Capital destruction. So the key difference is here, the professional traders have realistic expectations and targets, And their target is to get rich slowly. And they want to trade forever, or at least until retirement, or until they die. Retail traders, very unrealistically high targets, and they never meet their targets. So they stay poor or get poor quicker. Expectations are never ever met. Targets are never met, and they just blow up. That's the typical scenario. Now I want you to think about this in terms of a retail broker. A professional trader's broker is the investment bank. That's an institutional broker. Let's think about a retail broker who's got 10,000 retail clients and 90% of them lose money. How does the business grow? Let's think about the reality of this business. If you own the brokerage company, how do you grow it if 90% of your clients lose money? You have to spend a significant amount of the money that you make from the guys blowing up, and it's usually between 30 and 50%, on marketing to get new guys to open accounts to replace the accounts that are blowing up and closing down. That's the only way you can actually stay at the same level. If you want to grow, you need to open more accounts than the ones that are being closed down. So imagine you have 9,000 out of 10,000 clients down at any one time. What would you do if you had access to 9,000 traders who always lose money? Come on, someone think outside the box here. There we go. You take the other side of their trades, wouldn't you? Why? Because then you'd have a 90% win ratio. You'd be the best trader in the world. So what we're going to show you here applies mostly to international markets outside the US. As we mentioned earlier, US CFDs were banned. So we're going to look at CFDs mostly, how these contracts operate, how the brokers operate within that industry. We'll have a look at US brokerage companies later. US guys mostly trade options. So we'll concentrate on outside the US, as in the rest of the world. So we're going to be looking at UK, Europe, Hong Kong, Singapore, Middle East, Australia, New Zealand, South Africa. What we'll show you here initially is what happens in all of these territories. All the same brokers are in all the same places. So I've mentioned this briefly again, the 90-90-90 phenomenon. Who knows what that stands for?
90% of traders lose 90% of their money 90 days.
Yeah, 90%. Let's be specific of how it works. 90% of retail traders, so the retail brokers' clients, lose 90% of their deposited margin within 90 days. So what is margin? It's the money you put in your account, and you get leverage when trading CFDs. But what is a CFD? Well, you don't actually own the asset. CFD is contract for difference. So if you were to buy a CFD on a stock, it's a contract that is supposed to mirror the price of the underlying asset, as in the real stock. So when the real stock goes up a point, the contract is supposed to go up a point at exactly the same time. That's what it's supposed to do. So when you're on the platform and you press the button to buy on a CFD platform, you don't own the stock. You own a contract that mirrors the price. And that's why it's called a derivative, because the price of the contract is derived from the underlying asset. And there's two types of margin. There's the initial margin that you put in your account, and then once you have a position, what we call variable margin. How much your margin is going up and down, how much you're making or losing. Because what happens at the end of the day, if you buy the contract and the stock goes in your favor, the broker pays the difference into your account. Contract for difference. If you have the reverse situation, the broker takes money out of your account if you're losing money. And what happens when your margin goes to zero? You get a margin call. You have to deposit more money in your account, and if you can't, the broker will stop you out of the position and you're done. Your account's blown up. So that's why we call them contract for difference, because the difference is taken out or put in. Typically in Forex, obviously Forex is a very popular instrument. for a popular asset class for retail traders. Typically in Forex, whatever you deposit in your account, you are allowed to borrow up to 100 times what you put in your account. So what does that mean? Well, it's 1% variable margin, which means if you lose 1%, it goes to zero. So let's say you put $1,000 in your account, you'd be allowed to take up to $100,000 of risk, equivalent in the currency pair that you're buying or shorting. And if you lose 1%, you're gone. But what if you put 10 grand in your account? So in that scenario, you lose 100% of your margin. What if you put 10 grand in your account and had 100 grand risk? Well, if you lost 1%, you'd lose 10% of your margin. That's how it works. So what do most retail traders do? What do you think the average balance of a retail trader's trading account is in the UK, Europe? So this is in rest of world, outside the US. It's a couple of $1,000s. And what are they doing? Taking $200,000 positions in Forex and blowing up in days. 100 times leverage, we call it. With stocks, commodities, ETFs, you're looking at 10 times leverage. So the numbers work exactly the same. If you lose 10%, you're out. But think of all these guys on the platform trading in the way that we've discussed, in the opposite way, to the way retail professional traders do it. Wouldn't it be amazing if we ran a company where we could just take the other side automatically every time they traded? We'd win 90% of the time. And this is the big problem. The way the brokerage industry works is that there's major conflicts of interest with retail traders. So major conflicts of interest between the broker and their clients, the retail trader. That creates a scenario where that literally happens because those guys want it to happen. The infrastructure has been built not for your benefit. Your objective is to turn up and make money. That's not their objective. Their objective is the opposite to yours, which is to take your money. So the first two conflicts of interest are really obvious. There's four main conflicts of interest. Spread and commission. So spread. What's spread? Well, if you buy something, you're buying it in the market, for example, at 6, and if you sell it, you're selling it at 5. So the broker makes 1. You pay the spread. So if the broker has 2 clients, the broker can buy it at 5 and sell it to you at 6. So 1 seller, 1 buyer. They make a spread. So they make a spread on every trade and take turns. We'll use this phrase again in a second. The word turn. Taking a turn is buying something at 5 and selling it at 6. So the spread and commission. So spread happens in Forex. There's no commission in Forex. You pay the spread in Forex. You pay the spread in stocks. But in stocks, you also pay commission. So you'll pay a percentage commission to trade in and trade out. So those two are really obvious conflicts of interest, but everyone tries to ignore them for some reason. So what does that mean? Those two things mean that the broker, by default, is absolutely 100% incentivized by volume and frequency. So they want you to trade in the biggest size possible as frequently as possible. So put 2 and 2 together. Why do they lend you 100 times what you put in your account? Because they get paid. The next two are not so obvious. The financing turn and the OTC gain. Does anybody know what OTC means? Over the counter. Right, so CFD contracts are over the counter contracts. Okay? And when they take the other side and make money, it's called an OTC gain. First incentive, we'll just get it down now. First retail broker incentive, volume and size. trading as frequently as possible in the biggest size possible. That's how they get paid. The other two, not so obvious, this is how it works. So the first one, financing turn. Who finances the leverage with brokers? Does the magic money fairy from the sky come down and give brokers money to lend to you? Where does it come from? Comes from investment banks. So if you want to set up a retail brokerage company, get yourself $30, $50 million, go to an investment bank, use that money to collateralize some debt, and ask them to borrow $250 million. Ask them if you can borrow $250. You get yourself a revolving credit facility, build a trading platform, and then farm out the credit on the platform to retail traders. So you borrow at, pretty much now, this will be the case, you borrow at 2 3/4, farm it back out for a point higher. So you take a financing turn on the debt. But what else gets collateralized? How do you get away with turning up to the investment bank with only $30 to $50 million regulatory capital and then borrowing $250? How do you get away with that? Because retail traders are going to open trading accounts. And when they put their money in the accounts, that money is collateralized as part of the revolving credit facility. And then you're basically putting the money in your account and sponsoring the broker to lend you money at a point higher. So essentially, you're financing your own rape. That's how it works. Now, of course, if 90% of clients lose money and you want to take the other side, you want to borrow as much as possible so you can take that other side. So, of course, you're going to lend out as much as possible, teach people how to trade as frequently as possible in the biggest size possible, so they pay you. You take a point on the financing, and then you get the gain on the other side when they lose. So retail broker incentive 2. Provide third-party financing with no risk or very little risk. Take a turn out the financing and use the credit facility to encourage retail traders to trade as frequently as possible in the biggest size possible and take the other side of all the trades. Not a bad business. And again, why are we looking at this? You need to understand the realities of the industry. Step 1. This is how it works. Step back for a second and think how long it takes you to open a trading account. Quite a few of you have opened trading accounts before. How long did it take you? Someone shout out. 10 minutes. What did you provide to open the account? Passport, utility bill. So identify yourself, utility bill, confirm address. You are who you say you are. What else did you have to do? You'll sign some terms and conditions because they'll qualify you as someone who's got money. Did you read the small print? Sure. And we're assuming everyone's non-professional. So in the terms and conditions, what are you actually doing when you sign them off? The only line that matters is one line, and it'll be in there somewhere. I'm happy to lose all my money. And the broker is not, it's not his fault. Broker's got nothing to do with it. It's a risk disclaimer. And this is what the industry looks like. This is what the trading industry looks like, the infrastructure. On the left-hand side, we've got exchanges and investment banks. And everything to the right of that is retail brokers, trading educators, retail traders. We've put a few labels under each. So the investment bank, what are they doing? They're providing the credit facility and clearing to the brokers. And that order flow goes through them electronically down to the exchanges and trades. It all happens within less than seconds. What's the retail broker doing? Well, the retail broker, if we skip the educator for a second, the retail broker is providing the access, so platform and software, financing, leverage, and liquidity. Now that's important because without the brokers, you wouldn't have liquidity. So that's the positive that retail brokers provide to retail traders. You can access liquidity that you wouldn't get anywhere else as a retail trader. So what does that tell you? It's a necessary evil to use retail brokerage platforms as a retail trader. You have to use them. We'll come back to that later. But what type of education do you get from brokers? Well, there's an incentive. There's a conflict of interest. You're not going to get education that helps you make money. You're going to get education that makes you behave like a monkey. Press the button as many times as possible per day until you blow up. And it'll be wrapped up in some sort of strategy. Usually a technical analysis strategy, very short term, less than a day, in hours, in minutes. Follow this line on a chart. Every time this line crosses this line from below, buy. Every time this line crosses this line from above, sell. Signals, very typical. You're not going to get education that works. So they're providing this to the retail trader. What have we called the retail trader? Dumb money. Why? Because they believe everything that the broker tells them. And on the left-hand side, we've got the smart money, investment bank traders on prop desks. Why do we call them smart money? Because they believe nothing that anybody tells them in the market who has conflict of interest. We'll go into more detail on that later. They do the opposite of the dumb money. What's the retail trader paying? Spread and commission. What are they providing? They're providing the demand for the financing, the demand for the false narrative, and the demand for losing trades. So they're providing the liquidity for all of those conflicts of interest.
睇到條題都 feel 到淡淡嘅憂傷啦，更何況係當事人呢？開始講古仔啦！出事嘅呢個產品 XIV 其實係 VIX 恐慌指數嘅反向 ETN， 市場越穩定，價格就升越多。不過美股呢兩日大跌，搞到 XIV 重創，喺幾個鐘內喪插90%。有位 XIV 炒家3年前開始掂 XIV 交易，5萬美元做本，3年就賺到250萬美元，再加上屋企人同朋友投資多150萬美元。不過隨住 XIV 重創，佢就喺網上出 post 話：
我已經冇咗400萬美金，3年嘅收入同埋蝕埋投資者嘅錢，我咪應該自殺啊！
不過都有唔少網民質疑，但佢真係有圖有真相㗎，仲話
原本可以請我嘅大家族食餐好，都諗住買車買樓，請埋老豆老母度假，不過家下乜都冇啦。
你仲咁後生，吸取翻教訓，下次就唔會咁樣㗎啦。
今次係你唔好彩，但唔係世界末日嚟㗎。
呢位輸錢嘅炒家仲話自己失敗係因為傲慢同愚蠢，網民都安慰你咯，今次就當教訓，喊一陣好啦。